Okay, so welcome to the deep dive, everybody. Today we're diving into a topic that I think is on a lot of people's minds.
Absolutely.
Something that comes up whether you're reading the news or maybe even just having dinner with friends.
Right.
It's the stock market.
Yeah.
And I feel like the stock market has this kind of reputation, you know, for
Inference.
being risky,
For sure.
maybe even a little bit scary for some folks.
Definitely.
So what we're going to do today is use some really interesting information that we found and kind of cut through some of that noise.
Yeah.
And really explore, is it really as dangerous as it sounds, or is it just maybe misunderstood?
I like that. Yeah.
And our goal today is really straightforward. We want to give you like a really quick crash course
Absolutely.
so that you can walk away feeling a little bit more comfortable with how this whole thing works.
Yeah. I think the stock market often gets painted as this like exclusive club.
Oh, for sure.
It's like a playground for Wall Street hotshots
Right.
where you need like secret codes and, you're up against impossible odds.
Right. Right.
But when you really break it down, the basic idea is actually pretty simple.
Okay. I like that.
It's about ownership.
Ownership. Okay.
Yeah.
So imagine like a marketplace,
Oh,
but instead of, finding fruits and veggies or whatever,
right.
you're buying and selling little pieces of companies.
That's it. Yeah.
And these pieces are called stocks or shares.
Exactly.
So picture this. You decide to buy a share in a company.
Okay.
Maybe it's like that streaming service that you can't live without.
Yeah.
What you're actually doing is you're getting a tiny slice of ownership in that whole operation.
It's like owning a tiny piece of the pie.
Exactly.
And here's where it gets interesting.
Okay.
The value of that piece,
Yeah.
that share,
Yeah.
it's not fixed.
It changes.
It moves around.
Okay.
It depends on how well the company's doing.
I see.
So if they're making a lot of money, if they're
Yeah.
launching cool new products, doing well overall,
Right.
then more people are going to want a piece of that,
Makes sense.
which drives the stock price up.
Supply and demand.
Exactly.
Basic economics.
Exactly.
But on the other hand, what happens if the company isn't doing so well?
Right.
Like maybe they have like a PR disaster,
Mm-hmm.
or maybe their earnings take a dip.
Yeah.
What happens then?
Then the value of their stock could go down
Okay.
because it's all tied to how healthy and how promising that business looks.
So it's like a constant, ebb and flow based on
Yeah, it's a dynamic.
perception and how the company's actually performing.
Absolutely.
Now, I bet there are some people listening right now thinking,
Yeah.
isn't this just for like rich people?
Right.
Or, like you have to be like a math whiz or something to get involved in this?
Yeah, that's a really common misconception.
Yeah.
And I think, thankfully, it's becoming less and less true
Yeah.
because the world of investing is changing.
Right.
It's becoming much more accessible
Okay.
to everyday folks.
So when you compare the stock market to like other ways that people might invest, like, cryptocurrency,
Mm-hmm.
which sometimes feels like it's moving at the speed of light,
Right. Very volatile.
or real estate, which is often a much slower process
Yeah.
and not as easy to get into.
Less liquid.
Yeah.
For sure.
Stocks occupy this interesting middle ground.
Yeah, they strike a balance, I think.
Right.
Because they offer this good level of liquidity.
Okay.
Which means you can usually buy and sell them pretty easily.
Right.
Without too much hassle.
You're not locked in for like, decades.
Exactly. Yeah.
So now you're listening and you're thinking, okay, this is actually starting to make some sense.
I hope so.
This isn't as intimidating as I thought it might be. So
Yeah.
how do I get started?
Usually the first step
Yeah.
is to open something called a brokerage account.
A brokerage account. Okay.
Yeah. And basically, this is your gateway to the stock market.
Okay.
And luckily these days, there are tons of these online platforms.
Yeah. I've heard of some of these.
Yeah, you've probably heard of like Robinhood or Fidelity or E-Trade,
Right.
and in some places, Zerota.
Okay.
But one thing that's really been a game changer
Okay.
is this concept of buying fractional shares.
Fractional shares.
Yeah.
So what is that?
So imagine, a single share of a company that you really like
Uh-huh.
costs, hundreds of dollars,
Right.
even thousands of dollars sometimes.
Yeah, like some of the big tech companies.
Exactly.
Yeah.
You don't have to shell out that entire amount. You can buy just a fraction of a share.
I see.
So you could buy like a tenth of a share or, whatever you can afford.
So that makes it much more accessible.
Way more accessible.
Especially if you're just starting out.
Absolutely.
Yeah. Okay, so I've got my brokerage account.
Okay, you're set up.
I'm ready to invest.
You're ready to go.
What kind of stocks should I even be looking at?
Right. So generally speaking, stocks fall into two main categories.
Okay.
You've got individual stocks, which is where you're picking, specific companies.
Yeah, like a company that I really like.
Like exactly, like a brand that you
Yeah.
love or,
Right.
a tech giant or something.
Yeah.
And you're buying shares directly in that one company.
Okay.
And then you've got ETFs,
ETFs.
which stands for exchange traded funds
Okay.
and index funds.
Okay.
And these are kind of like pre-made baskets of stocks.
I see.
So it's like a collection of many different stocks all bundled together.
So you're not putting all your eggs in one basket.
Exactly. Diversification.
Okay.
It's like having a balanced meal.
Right.
You're spreading your investment across a bunch of different companies,
I see.
which helps to kind of cushion the blow
Yeah.
if one or two of them don't do so well.
So that's especially good for somebody who's maybe just starting out.
Yeah. For beginners, it's a great way to get started
Okay.
because you're not taking on as much risk.
Right. And that brings us to kind of like the elephant in the room,
The big question. Yeah.
the risk factor. I mean, you watch the news, you see the market go up and down.
All the time.
It feels like a gamble.
Yeah, it can feel that way.
So let's address that head on.
Absolutely.
Is the stock market risky?
So I think it's important to be upfront.
Okay.
Yes,
Yeah.
there is risk involved.
Okay.
When you invest in the stock market, the value of your investments can go down
Right.
as well as up.
That's important to remember.
Yeah, but it's also important to consider the risk of not investing at all.
Oh, that's interesting.
Because if you just keep your money in a savings account,
Yeah.
earning very little interest,
Right.
over time, the value of that money can actually decrease.
Because of inflation.
Exactly, because of inflation.
Yeah.
Things get more expensive,
Right.
and your money doesn't buy as much.
But your money is actually losing value even though it's just sitting there.
Exactly. It's losing purchasing power.
Okay. So it's like two sides of the same coin.
Right. You got to weigh the risks.
You have to look at it from both perspectives.
Absolutely.
Okay, so if I am thinking about dipping my toes into the stock market,
Yeah.
how do I manage that risk?
Well, I think one of the most important things is to start small.
Okay.
Only invest money that you're comfortable not touching
Okay.
for like a significant period of time.
Like how long are we talking?
Ideally, like 5 to 10 years
Hmm.
or even longer.
5 to 10 years. Wow.
Yeah, because the market, it goes through these cycles.
Right.
It goes up, it goes down. We call that volatility.
Okay.
But historically, people who have stayed invested through those ups and downs
Uh-huh.
have often come out ahead in the long run.
So it's about playing the long game.
Exactly. It's a long-term game.
Okay, so for those listeners who are now thinking, okay, I'm ready to maybe pick some individual stocks,
Yeah.
what are some things that I should be looking for in a company?
Right. So there's no magic formula
Sure.
for picking winning stocks,
Right, of course.
but there's some basic things you can look at.
Okay,
Like, is the company actually making money?
Yeah.
Are they profitable?
that makes sense.
Are they growing? Are they expanding their business?
Yeah.
Do they have something that gives them an edge over their competitors?
Like a unique product or service or something like that.
Exactly. We call that a competitive advantage.
Okay.
And maybe the simplest question of all.
Okay.
Is it a product or service that you yourself would use?
Oh, that's a good one.
Yeah,
Because you know that market.
exactly.
Yeah.
You understand it.
Okay, so that actually reminds me of something that Warren Buffett always says.
Oh, yeah.
He says, invest in businesses that you understand.
Makes sense.
So, if you're like a regular at a particular coffee shop
Right.
and you feel like you kind of get how their business works,
Uh-huh.
that could be a starting point for you to do some research.
Exactly. It's about knowing what you're buying.
Yeah.
And I think it's also really important to stay informed.
Okay, so how do I stay informed?
So keep an eye on company news,
Okay.
like their financial reports.
Okay.
We call those earnings reports.
Okay.
New product announcements. Any big changes in their leadership.
Got it.
Because all of those things can affect the stock price.
That makes sense.
And you can usually find that information on the company's website
Okay.
or through, reliable financial news sources.
Okay, so as we're having this conversation, I'm realizing that there's a whole vocabulary
Yeah.
that comes with the stock market.
There's a lot of jargon.
So can we break down some of the essential terms that our listeners might come across?
Sure. Let's start with bull market and bear market.
Okay, bull market, bear market.
So a bull market is basically when the stock market is generally going up
Okay.
and there's a feeling of optimism.
To like good times.
Good times.
Ah.
Yeah, people are feeling good.
Okay,
A bear market is the opposite.
so things are trending downwards.
Yeah, the market is generally declining
Okay.
and there's more of a cautious mood.
People are a little bit more nervous.
Yeah, a little bit more pessimistic.
Got it. Okay, so bull market, good times, bear market, proceed with caution. Okay, what about dividends? I hear that term thrown around a lot.
So dividends are basically a portion of a company's profits
Okay.
that they decide to share with their shareholders,
Okay.
the people who own their stock.
It's like a little bonus.
Yeah, it's like a reward for being an owner,
So it's like free money.
kind of.
Yeah.
That's pretty cool.
And for some companies,
Yeah,
this happens regularly.
nice. So if you own stock in a company that pays dividends, you can actually get like a regular stream of income.
Exactly. That's the idea.
Interesting. Okay, so we've got bull market, bear market dividends.
Yeah.
What about PE ratio? That sounds complicated.
So the PE ratio, which stands for price to earnings ratio,
Okay.
it's a way for investors to try to figure out if a stock is expensive or cheap
Okay.
relative to its earnings.
So it's like a valuation tool.
Exactly. It's all about valuation.
Okay.
So basically, it compares the company's current stock price
Uh-huh.
to how much profit it's making per share.
I see.
So a higher PE ratio might mean that investors are really optimistic.
About the company's future growth.
They think it's going to go up.
Exactly. They think it's going to keep growing.
Okay.
A lower PE ratio
Mm-hmm.
could mean that it's undervalued,
Okay.
or maybe it's a more mature company.
That's not growing as fast.
Yeah, that's not growing as fast.
Got it.
But it's important to note that different industries
Right.
might have different typical PE ratios.
Okay, so context is important.
Always.
Okay. And then finally, what about market cap?
So market capitalization,
Mm-hmm.
often shortened to market cap,
Okay.
is basically the total value of a company
Okay.
in the stock market.
Got it.
And you calculate that by multiplying the company's current stock price
Mhm.
by the total number of shares that exist.
Okay, so it's like a measure of the company's overall size.
Exactly. It's
Yeah.
like their footprint in the stock market.
Interesting. Okay, so we've thrown a lot of terms at our listeners today.
Yeah, we have.
But I think, as you said, the more you're exposed to these terms,
Uh-huh.
the more they start to make sense.
They become less intimidating.
Right, so to wrap things up,
Yeah.
let's give our listeners some actionable advice
Love it.
if they're ready to kind of take those first steps into the stock market.
Okay, so if I had to pick 3 key takeaways
Yeah.
for new investors,
Okay.
number 1, resist the urge to try and time the market.
To time the market, what do you mean by that?
Trying to predict the perfect moment to buy or sell.
Oh, so like buy low, sell high.
Exactly. That's the dream.
Right.
But it's incredibly difficult,
Yeah, even for the pros.
even for professionals who do this for a living.
Right.
So don't stress about trying to time it perfectly.
Okay, that's good advice.
Number 2, start early,
Okay.
even if it's with small amounts.
So like even if I can only afford to invest like $50 a month.
Absolutely. Because the power of compound interest,
Yeah, I've heard of that.
it's like magic.
What is compound interest exactly?
It's where your earnings generate more earnings.
So like interest on interest.
Exactly. It's like a snowball rolling downhill.
I see.
It gets bigger and bigger over time.
So the earlier you start, the more time that snowball has to grow.
Exactly. That's why they say time in the market beats timing the market.
I like that.
And number 3,
Yeah.
make learning a priority.
So I shouldn't just like invest my money and then forget about it.
No. You got to stay engaged.
Okay.
Read books,
Well,
watch videos,
okay.
stay curious about the companies you're investing in
Right.
and the broader economy.
So like be an informed investor.
Exactly. The more you understand, the more confident you'll be,
That makes sense.
and the less you'll be driven by fear.
Right. So we started this conversation with a big question.
The big one.
Is the stock market risky?
Right.
And I think the answer is yes, there's always going to be some level of risk.
That's true.
But it also seems like it can be a really powerful tool
Absolutely.
for building wealth over the long term,
For sure.
especially if you approach it with, a basic understanding of how it works.
And a long-term perspective.
Right.
Yeah. And I think one of the beautiful things about investing is that when you start early,
Yeah.
even with small amounts, you're giving your money the maximum opportunity to grow.
So you're letting your money work for you.
Exactly. It's like planting a seed and letting it grow.
I like that analogy.
So for our listeners who are still kind of processing all this,
Yeah.
a good next step might be to think about what questions you still have.
Oh, that's good.
What are your biggest fears or concerns about investing?
Right, because those are exactly the kinds of topics
Yeah.
that we could explore in future deep dives.
Absolutely. So let us know
Yeah.
what's on your mind.
And on that note, we'll leave you with this thought.
Okay, hit me.
Don't just work for your money.
I love it.
Explore the potential of making your money work for you.
That's the goal.
Thanks for taking this deep dive with us.
Thanks, everyone.